Thanks for joining. We're gonna wait another 30 seconds or so for more people to come on the call. Jeff, you're muted, I think. I still can't hear you.
What about now?
Yeah, now I hear you.
Great. Good save. All right. Give people another 30 seconds to trickle in. This one's I feel like a bit more of an esoteric topic, so we'll see how many folks decide to sit with us. But for those who are here, as I think you all know, you can always watch this stuff both on the recording link, which we'll share with you if you've registered, and then we put all of this in bite-sized chunks on our YouTube channel as well. So even if folks do miss a couple of minutes, they can always catch up. All right, let's numbers are ticked up a little bit, so let's go ahead and dig in. As always, I know a lot of the names I'm seeing are repeat attendees. So you've heard this before, but feel free to chime in. Let us know who you are, where you're from, so we can kind of put some faces to it as we're talking and as we get moving. We're here today for, I don't know, the umpteenth time in our series of webinars on all of these topics to talk about estate tax specifically. We're digging in now several layers deep. We've talked to you about, why you might do estate planning. We've talked to you about specific vehicles. And today we're here to talk about, now one layer deeper, which assets you're going to gift to trust for your kids or for your clients' kids. So I'm Jeff, as I think many of you know. I run product here at Valor, and I've talked to a lot of you face to face, since I am also kind of the tip of the spear on partnerships and talking to new partners and clients. But the real star of the show is Peter, who's here with me, who runs our estate side planning. Peter's going to be talking most here, so I'll turn over to him in a second. But I'm just going to give you all a pretty quick rundown of where we're going, and then maybe just a minute on framing of these questions, and then Peter's going to take it away. So the idea here is that we're going to do a couple of minutes on the basics, just to refresh. We're going to talk about what are the gift and estate taxes, talking about the exemption, which I know most of you are very familiar with. But even if you're not, we'll catch you up as much as you need to know for these purposes. And then we'll get into the meat of it, which is really here, which assets are you placing in these trusts? We're going to be talking about estate tax trusts in general. I know many of you know there are a number of different vehicles that Valor helps you set up and that you can set up in this space. We're going to be talking about a lot of them today. We are going to call out GRATs specifically at the end because they have their own special considerations, but this will be a conversation that applies really to all estate planning. 1 second on framing of this discussion before we get into the substance. As we were thinking about how to present these materials, a question kept arising, which was, how and when are people thinking about this question, the question of which assets to put into a trust? You might think that the question arises when someone is really starting out with this process and thinking, what should I be doing for the next generation? And you might think that the asset question comes first. That's not the way we think about it, and it's not the way that we think you should think about it. Rather, the time that this question should come into your mind and should drive some of your planning is really second. The first question is, should I be doing estate tax planning? If so, what vehicle makes the most sense given my situation, given my age, my family situation, my assets, whom I'm planning for, and when? You pick a vehicle or more than one trust strategy, and then the question comes up that we're going to be talking about today, which is, which assets should you be putting into those trusts? And it's important to realize that those first set of questions are really the critical ones. They're also incidentally something that Valor, of course, can help you with. I know many of you have seen our tools on the platform. We've got the full panoply of planning side tools to help you identify those strategies that might apply, and then importantly to run quantitative analyses to figure out which one is going to be the highest return. Once you've done that, then the question comes, which assets should you be planning for? And that's what we're going to talk about today. So with that primer, I guess, out of the way, Peter, go ahead and take it away.
All right. So just briefly, it's worth talking about gift and estate tax a little bit so that people have some context on the larger picture. So in the United States, everyone is subject to both the gift tax and the estate tax. So there are two different taxes. The gift tax applies to transfers during your lifetime. The estate tax applies to transfers upon death. And they're both levied at 40% at the federal level. A bunch of states, 12 states in DC have their own estate taxes, which increase rates a little bit beyond 40%. So if you're in one of those states, rates can be as high as 52%. But for most people, it's 40%. There's a few ways to avoid gift and estate tax, and so the biggest is there's a lifetime gift and estate tax exemption amount, which is currently $13.99 million per donor. So the vast majority of people never pay gift tax, never owe estate tax, because they have less than $14 million of assets during their lifetime and when they die. But if you're not in that category, if you think you're going to be over $14 million in assets, then suddenly the gift and estate tax becomes a huge issue because it's a 40%, maybe 50% tax on all of your net worth above $14 million, essentially. So it's a pretty significant tax planning issue for people who are higher net worth.
Peter, just a little note there, and I know we don't get into reading tea leaves politically, really, because it's impossible to know what's going to happen. But that number does change over time, right? I know we're going to get into this, but that 14 million is the number to have in mind right now. But
yeah,
it's a moving target.
Yeah, so it's a moving target. It's 14 million. If there's no tax bill this year, or the tax bill doesn't pass, then it'll revert automatically to about 7 million, which is half the current level. Republicans are trying to extend the current levels beyond 2025. So we'll see how that goes. But the general conventional wisdom is that it's going to be extended. And so it should remain at around 14 million for the next few years.
Right.
But
so the principle, the numbers are important, and of course, there are a lot of families that sit between 7 and 14, or between 14 and 28 for a married couple, and so that's really consequential. But the principle stands, which is you get to give away a certain amount during your lifetime and when you pass away, and anything you give away over that level, whether it's 14 million or that changes over time, any dollars you give away over that level are going to be taxed, unless you do some sort of advanced planning, which is, of course, where Valor comes in.
Yeah. And we have this little chart here shows the two possible paths of the estate tax exemption after this year. So either it stays on the sort of green line or it suddenly shifts to the purple line. But that's the general idea. And so as Jeff was saying, sort of the premise of this webinar is that you've already decided, already determined, you're going to be over the exemption amount. You have to plan for estate tax, and you're trying to figure out the best assets to gift. And so you have 20 assets, and which one should you gift, or which assets should you gift to trust?
And that answer, right, Peter, we'll go through this and we'll talk about it. But in general, that answer does differ with the type of trust that you set up, right? And so working with Valor or with whomever you work with to do this sort of planning and eventually implementation of these vehicles, you're going to make a decision as to the type of vehicle that makes the most sense for you. Maybe it's an intentionally defective grantor trust, or a GRAT, a crummy trust, who knows, a life insurance trust. But once you've made that decision, there's these different features that dictate what's going to be optimal to put in. That's where we're heading now.
Yeah. I mean, really the big dichotomy is dynasty trust, which is most estate tax planning trusts, versus GRATs, or grant or retained annuity trusts. Those are the two trusts that really have different asset types that make sense for them. And so most of the presentation is focusing on dynasty trusts. So that includes intentionally defective grantor trusts, spousal lifetime access trusts, irrevocable life insurance trusts, non-grantor trusts. So that's really the vast majority of trusts that people make gifts to. GRATs are sort of a special case, which we'll discuss towards the end of the presentation.
And it's also worth just noting that those are the vast majority of trusts that folks do. They're also the highest return, and those are obviously related. And if you ran these numbers, you'd find that what's usually recommended in the vast majority of cases across net worths, across types of kind of family situations, is that set of trusts. And so that's definitely the focus. The principles, though, that are going to dictate what assets that you put in, and we're going to dig into each of these, but these ideas, right, Peter, mostly arise out of the nature of that exemption and the gift tax, the gift and estate tax, right? The idea being that you want to get your money out of your taxable estate, and how you can optimize that move depends a little bit on the type of asset. Essentially, what you're trying to do in theory is to move assets out of your estate when they're not worth very much, so that you don't use up much of your exemption, and then getting more value to your heirs, to your beneficiaries down the road, and also making sure that it's liquid for them and that they can access it. And I think that kind of key principle, which is unified here on the slide, is going to capture a lot of the thinking here. Of course, there's some nuance, there's legal requirements, there's some things that we'll talk about, but the big idea is what you're trying to do is pick assets that are going to help you get assets out of your estate, do so when they're relatively low value, see them grow, and allow your beneficiaries to get access to the money down the road. Is that fair to say?
Yeah.
Okay. So with that in mind, I guess let's talk about each of those individual factors.
Yeah. So really the really big most important factor is appreciation potential of the asset that you're thinking of gifting. And so the way that the gift and estate tax works is what matters is the value of the asset at the time of the transfer. And so if you have some type of asset that you expect to appreciate a lot, if let's say it's currently worth $200,000, but you think it's going to be worth $5 million in 10 years. If you gift it now, you can get that, soon to be $5 million asset out of your estate while only using $200,000 of your gift and estate tax exemption. And so, versus if you transferred a $200,000 asset that wasn't going to appreciate very much, in 5 years it was worth $240,000. The trust would only have $240,000 in it instead of $5 million in it, but you would have used the same amount of a gift tax exemption to get it there. So you'd rather transfer the really rapidly appreciating asset than the not very rapidly appreciating asset. Although you can't always predict the future perfectly.
And that, I think, is a really important caveat to this. The theory is absolutely sound here. The idea that getting assets in there that are low value now are going to grow a ton is a great idea. Is it fair to say, Peter, that it's better to take a swing here and make an attempt to pick a winner and get it into the trust rather than kind of not do anything? I guess if you're sitting on two assets and you're not sure which one is going to be the winner, it's better to get even the one that grows 10% into the trust than to put nothing into the trust.
Yeah, I mean the asset that grows 10% is still a win because you're still getting the appreciation out of your estate. But all else equal, if you had a crystal ball, you'd want to transfer the one that was going to appreciate more.
And so as a result, you can certainly make some kind of asset class determinations here. We have plenty of clients who, of course, don't know what's going to happen, but they're sitting on a mix of early stage startup equity, late stage private company equity, mature public stock, crypto, real estate, and you can certainly make an educated guess there. It's much more reasonable to put kind of earlier mid stage startup equity in one of these trusts than stock in some well-established 100-year-old company whose stock probably has already priced in a bunch of growth. That being said, if you had done this with Nvidia 5 years ago, you would be sitting pretty, and that was of course not perfectly predictable. But in general, more volatile, smaller stocks and things that are likely to have that kind of explosive growth are going to be the choice here.
Yeah. So the second factor is discountability. And so what this is so when you transfer an asset to a trust, it's considered a gift for gift tax purposes, and so you have to get that asset valued. So you have to get it appraised if it's an illiquid asset like real estate, for example, or a private company stock. If it's public company stock like stock in Nvidia, you don't have to get it valued because there's a way to value public stock without an appraisal. But if it's anything illiquid, you'll have to engage an appraiser to appraise it. So the advantage of this is you actually get discounts, valuation discounts, by gifting illiquid assets, and I'll explain more what I mean. So if you gift $100 or 100 shares of Nvidia stock, that's worth whatever the fair market value is. So if the stock's trading at $120 a share, and you transfer 100 shares, that's 120 times $100, and so that's $12,000, I think. But if you gift at 20% interest in, let's say, real estate, you get the real estate appraised for $1 million. The 20% is actually going to be less than the value of that 20% interest is going to be less than 20% of the $1 million property, because the IRS would say, look, there's that 20% minority interest is going to be it's going to be very hard to sell it, so it's not very marketable, and so nobody's going to buy your 20% interest in real estate that you own 80% of, and also nobody's going to want a minority interest in that illiquid asset. They're going to want at least a majority if they don't have full control. And so basically, the appraiser applies a discount to these illiquid assets, and they come up with a number, and that number is usually around 30% less than what you think of as the proportionate fair market value. And so a 20% interest in a $1 million illiquid asset might actually be worth closer to maybe $140,000 instead of $200,000 because of that valuation discount. And so basically what it allows you to do is it allows you to shrink the value for gift tax purposes, even though you're still transferring $200,000 of stuff. You're able to use less gift tax exemption, which means that instead of being able to transfer $14 million of stuff, you're essentially able to transfer like $20 million of stuff. And so you get more wealth into the trust while using the same amount of exemption that you would have otherwise. So.
That's that last kind of half sentence is an important one. I have to admit, with the last factor, the kind of the idea of potential explosive growth makes a ton of sense, and you can make a strategic decision between two assets. Which one do you think is going to grow more? Here, the question of what's the action item or what's the guidance here is a little bit tougher, right? If you're sitting on multiple assets, maybe of similar value, sure, choose the one that's discountable. But yeah. I guess how would you frame the planning decision or the question you'd put to a client when they're deciding they've got an IJIT set up and they're thinking, what do I put in there? Should they go hunting for discountable assets, or is it more on the margin? If you've got a couple of options, you might as well choose the one that's
Yeah, I would say you get more bang for the buck, but by transferring in a liquid asset, especially if it's a minority interest in a liquid asset. Um, it just depends on what the assets are. But if you have private stock in a company, and then you also have Nvidia stock, in you have $1 million of each, you're probably going to use $700,000 of exemption to transfer the $1 million of privately held stock, but you're going to use $1 million to transfer the $1 million of Nvidia stock, $1 million of exemption, and so it's sort of a better deal,
right.
from a gift tax perspective if you transfer the privately held
Let
stock.
me. That's a good way of framing it. Let me put it this way. What you're ultimately trying to do is get as much growth as possible for every dollar that you put into the trust, right? Assuming that you're going to use up all of your gift exemption by putting stuff into trusts, you want that $14 million of assets or whatever amount you put in to grow as big as possible. And one way to do that is to choose assets they're going to grow from $1 to $50. That's what we talked about on the last slide. And here, one way to do that is to choose something that right now is valued at $1 because of this discountability, but actually is worth $1.30. And so when it grows, it's already got kind of a head start. I guess I'm just kind of vamping here, making up the way that makes sense to my head. Is that a helpful way to think about it? Am I on the wrong?
Yeah. I think that makes sense. It's basically, it's like the government's giving you a discount for transferring these sorts of partial interest in liquid assets.
Yeah.
And so you don't have to buy the shirt that's on sale, but it might make sense to buy the shirt that's on
If you don't like the shirt, you shouldn't buy it. But if there's an equal chance you're gonna like that shirt as the other shirt that's more expensive, of course take the discount. We've got I think a pretty quick question here from Omri that I put up in the
Yeah. So the answer is no. You can't use the 409A, and the reason is that the 409A rules are different than the gift tax rules. So for those who don't know, 409A is it's a type of valuation that privately held companies have to get for equity compensation purposes, for basically for options and stuff. So it's not really the fair market value of the it's not really looking at the fair market value of the shares in the company. It's doing some sort of weird thing, and usually it results in a really low number, like much lower than what a venture capitalist would invest at. And so the IRS doesn't treat 409A valuations as valid gift tax appraisals.
Riskiness.
Yeah, so this kind of pairs with the first one, which is appreciation potential. And so, yeah, when I was talking about that, I was saying you want assets that are going to appreciate a lot. The flip side is that you don't want assets that are going to completely tank or have a good chance of being worth nothing. At least if you're using a lot of exemption to get them into your trust. And so, let's say, let's say you have a meme coin and it's worth $1 million, and you think it might go up to $10 million, but also there's like a pretty good chance it's going to be worth nothing in a year. That's probably not a great asset to put into a dynasty trust. It might make sense for a GRAT, which we can get to in a bit, but something that risky is probably not great for a dynasty trust, because with a dynasty trust, you're using exemption to get that asset into the trust. And so if it ends up being worth nothing, you can't get a refund on the exemption that you've used. You've already used the exemption. And so, you'll basically have wasted that exemption amount. So it's much better to say, to give something that has appreciation potential, but isn't likely to totally go down. So like sometimes people have had small businesses, closely held businesses, that they founded, and they're very confident that it's going to be worth 10 times the value in 2 years because they have a bunch of big contracts that are about to fall into place and whatnot. And so in those cases, it makes perfect sense to use to use a little bit of exemption, and hopefully you get a bunch of growth after the gift. But you just don't want to take crazy risks, because that exemption amount is pretty valuable, and you don't want to waste it on something that's going to be worth nothing.
But it's a balance, and
Yeah.
something that has 10x potential growth might be worth the shot, especially if you've got a big chunk of your exemption left to play with. Income tax.
Yeah, so this is another big one. So there's a couple of big income tax considerations that you have to think about when you're setting up an irrevocable trust. It's going to be outside of your estate. And so the first big consideration is something called a basis step up. And so some of you might be familiar. So when you die, your assets, the assets that you own personally, get what's called a basis step up, which basically means any capital gain, any accrued capital gains are wiped out for capital gains purposes. So if you have a really appreciated, investment property, and you die, that appreciation for capital gains tax purposes disappears, and your children or spouse or whoever it is inherits the property with a basis equal to the fair market value. And so the ability to wipe out all of that accrued capital gain liability is very valuable. And so people don't want to give it up, all else equal. If you're someone who is going to be over the estate tax exemption amount, or if you think you're going to sell the asset during your lifetime anyways, because maybe you're 40 years old and you're gonna sell the property in the next 5 years anyways, then that basis step up isn't very important, or it's at least less important than the future gift and estate tax liability that you're going to be facing. But you still want to get the basis step up where possible. And so one way of having kind of the best of both worlds is you can gift an asset to an intentionally defective grantor trust, or any type of grantor trust. So this includes IDGITs, but it also includes ILITs, irrevocable life insurance trust, and also SLATs, which are spousal lifetime access trusts. You can actually gift an appreciated asset to one of those grantor trusts. The moment it leaves your estate, it'll no longer be eligible for the basis step up, but you can actually either buy it back or swap it in exchange for another asset in your name, as a way of sort of getting the low basis asset back into your estate before you die. So let's say I gifted. Let's say I had a real estate, some investment property. I gifted it to the trust. 20 years later, it's worth a lot of money, and it's very low basis, lots of appreciation. I might say, you know what, I have a lot of cash and bonds and stuff in my name that have high basis, and that investment property has a really low basis. And so I'm going to swap out that investment property so that it's back into my name instead of the trust. That way it'll get a basis step up when I die. And in exchange, the trust is going to get cash and bonds and other stuff with higher basis. And so it's kind of a way of having your cake and eating it too. So you're able to get the growth from the investment property out of your estate for that however many years, but you're also eventually able to get that basis step up when you die.
We've got a question that I'm going to pull up in a second, but just one little pause for a plug. The point of this session is not necessarily to talk about Valor, since our role here is really in the planning and in the implementation of these trusts, not so much in deciding which assets, although we're of course available to consult and help you decide. But it's worth noting that the kind of swapping that Peter's describing is one of the parts of administration of these trusts that Valor excels at. We essentially automate the process of identifying potential swaps like this and facilitating them. It's something that you have to figure out makes sense, and then you have to carry it out. And a big part of our value add across the board here is that we bring technology to bear on these questions and are able to automatically surface these sorts of valuation jumps and let you know, hey, a swap could make sense in this case. If you'd like to do it, let's do it with the click of a button. So just a little plug before I now pull up Tom's, I think, related question.
Yeah. So whether an asset is in an LLC or not, whether it's single member or multi-member, doesn't affect the basis step up. And so an asset in a single member LLC, if it's owned, if you're the member, it'll still get a basis step up when you die. But an asset in a multi-member LLC can also still get a basis step up. You wouldn't get a full basis step up. So like, if you own 20% of the LLC, if you're a 20% member and your friends are the other 80%, they're not going to get a basis step up for their 80%, but your 20% can still get a basis step up, even though there's other members of the LLC. So any asset that you own personally, whether that's an LLC membership interest or real estate or a partnership interest or whatever, is still eligible for the basis step up. So, and can the LLC be placed in a trust? The LLC can be placed in a trust, or your membership interest can be placed in the trust, but that does affect the basis step up.
We have an important clarification question that just popped up. Peter Sanjay asks, "What is basis step up?" I feel like we unfairly make some assumptions about knowledge base here. So, what is a basis step up? The idea here, for anyone who reasonably doesn't know the answer to that question off the bat, the idea is so when you own a capital asset and an asset that's appreciated over time, your cost basis is essentially the amount that you bought it for plus any investment you made in it. So if you bought a house for $1 and you put $1 into renovating it, and then you sell it, then that $2 is not taxed, whereas all the growth is. So basis step up means, as Peter said a few minutes ago, but I know there's a lot of text here and a lot of talking. So just to reiterate, the basis step up is when you die and an asset goes to your beneficiaries, your heirs. The cost basis jumps up to the value at the time that you die. And so but people aren't paying tax on essentially all the value that accumulated during your lifetime. So, sorry, we've got a second one on this.
Yeah, so there's another income tax consideration here, which is that certain assets are particularly well suited for trusts. And in general, income tax inefficient assets are very well suited for both grantor trust and non-grantor trust. So grantor trust, as I mentioned earlier, are trusts where the trust is disregarded for income tax purposes, and so that means that the grantor, the person who set it up, is on the hook for the income taxes. Non-grantor trusts are trusts that are treated as separate taxpayers for income tax purposes. And so why would you maybe want to put income tax inefficient assets into a trust? And so a couple reasons. So with a grantor trust, the more income tax inefficient the trust is, the investments are, the more income tax liability that the trust will generate, which means that the more income tax liability the grantor will be paying on behalf of the trust. But when the grantor pays those taxes, it's actually it's not treated as a gift for gift tax purposes, even though the trust is outside of the grantor's estate. And so it's actually a way to make additional gifts to the trust beneficiaries without those gifts being treated as gifts for gift tax purposes. And so if you had two assets and one of them was really income tax inefficient, and the other was wasn't generating income tax liability. Let's say it's stock that just appreciates but doesn't pay dividends. You're probably better off putting the income tax inefficient investment, like private credit or whatever, into the trust, so that you're paying off all the tax liability that the investment generates, rather than putting the stock in the trust, which is going to appreciate, but isn't going to recognize income, which means that the trust beneficiaries or the trust itself are going to eventually have to pay that income tax liability themselves.
Definitely, I think the most esoteric
Yeah,
one
it's
of.
a little esoteric, but the short answer is that it can be very efficient to put income tax inefficient assets into grantor trusts. And non-grantor trusts are separate taxpayers, and so if you're in a different state, you can put private credit. If, let's say you're in a high tax state like California or New York, you can put private credit into a non-grantor trust. That private credit probably won't have to pay state income tax, so that the income won't be subject to New York or California income tax. And so that's sort of a nifty way to avoid state income tax on an investment that's otherwise pretty tax inefficient.
We've got 3 more considerations here with about 10 minutes left. So
Okay, yeah, I'll go a little bit faster. So this one's pretty straightforward. If you're living off an asset's cash flow, you don't want to, you might want to think twice before gifting that asset to a trust, just because you can't retain an income interest in the asset once you've gifted it, and so you need to have some kind of plan for how you're going to replace the cash flow that you're gifting. Ideally, you'd have more cash flow than you needed, and so you'd be able to gift cash flowing assets without any negative repercussions. But the last thing you want to do is gift an asset to a trust and then have sort of a liquidity crunch, 2 years down the line when
if
you
you're
no
living
longer.
off the rental income from a property or the flow from bonds,
Yeah.
those disappear if you put them
Yeah.
into a trust, essentially.
Yeah, and
Right?
so in that case, you might be better off gifting assets that don't generate cash flow instead, even if it's otherwise a little bit less efficient.
Yeah.
Transferability. This is very straightforward. There's a few things that you just can't transfer. So retirement accounts can't be transferred during your lifetime. Obviously, you can name a beneficiary on your death, but you can't transfer your 401k to your kids today, assuming you survive the rest of the day, because there's just federal law, you can't do it. Unvested options can't be transferred. Sometimes partnership agreements say that this interest can't be transferred, and so you have to check the partnership agreement or any other sort of corporate documents to see if there's any restrictions like that. Another thing to watch out for with real estate is that sometimes transferring real estate causes property tax reassessments. That's the case a lot of times in California, depending on the trust. You can inadvertently trigger a property tax reassessment by transferring real estate to a trust. Florida has a similar issue. And then if you have a mortgage on a property, sometimes the mortgage will have language about transferability, and it'll say like if you transfer the underlying property that the mortgage is on, then the bank might be able to call the loan whenever it wants. And so you want to make sure that you're not triggering a due on sale clause either. Yeah, and this is really the final slide. It's just special things to think about when you're gifting to a GRAT rather than a dynasty trust. And so, for those who don't know, a GRAT is a type of trust that pays you an annuity each year. The annuity is usually set up so that it's equal to the amount you put in plus some amount of interest. And the interest is based on an IRS interest rate that's set every month. But the basic idea is that if you generate returns that exceed the annuity amounts that you're being paid by the trust, whatever's left over at the end of the term, it's usually a 2-year term, can pass to your children, or whoever your beneficiaries are, usually your children, free of gift tax. And so it's a way of transferring assets out of your estate without even using any gift tax exemption. With GRATs, the calculus for what you want to gift is a little bit different. You generally want to gift assets that are highly volatile, And the reason is there's no downside because you're not using a gift tax exemption. There's no downside in putting a meme coin into a GRAT only for the meme coin to be worth nothing. If it's worth nothing, you just haven't accomplished anything, but you're no worse off than you would have been otherwise. But if that meme coin ends up, quintupling in value, then you've transferred a ton of value out of your name into the trust.
And if I can help frame this decision, this is one where I think, unlike with the other factors, where the question is really, I'm already doing this kind of trust, which assets make the most sense? That's partly true here. If you're doing a GRAT, you want to search around for volatile assets that are likely to grow a ton and maybe have some downside because who cares? But also, this is one case where I think it actually might make sense to think, kind of to turn that question around and say, I have an asset that I expect to behave like this, and I know I want to give money to my kids or my grandkids or whoever. Now might be the time to do a GRAT. Because like I own a meme coin that's worth $1 million right now. I expect it to be worth 10 in 2 years. Maybe it's worth 0. But if it ends up worth 10 and I held on to it, well, that money is stuck in my estate now. And so if you think there's that chance of the big upside, but you're also risking that downside, that might be a time to tell yourself or to work with Valor to decide, hey, let me put some of this at least into a GRAT to hopefully capture some of that explosive growth and get it out of my estate to my kids. Is that fair, Peter?
Yeah.
Okay. I want to, before we go to the end here, I want to ask one more related question related to that sort of framing. Turning the question on its head, not so much we have a trust, which assets should we do? Are there any other types of assets where, kind of irrespective of your general planning, the fact that you own that asset might drive you to do one of these trusts? Let me put it another way.
Yeah.
If you're working to decide on whether you should be doing a trust at all, what we do is we look at your net worth, your family situation, how much gifting you've done, and run some calculations. And we determine, hey, you could save X dollars in total estate tax plus growth if you moved assets into a trust. And usually, if you're going to be over that estate tax, the answer is some sort of trust would be, and if you want to give your money away, some sort of trust would be efficient. And then you can think, well, maybe I'll put my NVIDIA stock in, maybe I'll put my private equity in, maybe I'll put my company stock in, whatever it is. One thing that stands out to me as an answer to this question, I own an asset. Should that drive me to do one of these trusts? Might be relatively depressed value or low value early stage startup equity, where like a meme coin, kind of, you think there's a chance of 100x growth, and you think there's a chance of it going to 0. And even if you're not yet anywhere near the estate tax limit, and the system wouldn't otherwise maybe suggest that it's time to start doing estate tax trust planning, you might still decide, hey, I think there's a chance that my $1 million of startup equity might be $100 million. So let me put it into a trust now. One, I guess, do you agree with me on startup equity? And two, are there any other assets that you think fall into that category of, hey, the mere fact that I have this asset might prompt me to look ahead and do some trust planning?
Yeah, I mean, you kind of touched on it, but the sort of the startup equity that is eligible for QSBS, qualified small business stock treatment, which we don't have time to get into, but basically it's possible to transfer QSBS stock to a non-grantor trust and get wipe out additional capital gains liability that way, and so you can get both the capital gains tax benefits and also the estate tax benefits that non-grantor trusts create. And so that's sort of a narrow use case, but it comes up. And so for those people, non-grantor trusts in particular can make a lot of sense.
And so I guess to summarize everything up to this point, the way I'd put it is, if you're going to be over the estate tax limit, if you're pretty sure that you're going to be over the limit, there's planning to do now. You should set up a trust, and then we can talk about which assets that you should put in. Or if you have highly volatile assets, that might independently tell you, hey, it might be time for a GRAT. And especially if you've got potentially high growth startup equity, that might tell you that it's time, even irrespective of other factors, to think about setting up, for example, a non-grantor trust, a QSBS stacking trust. And so there are a lot of reasons why you might do one of these things. whether it's because you already have a lot of money, or you expect to, or you've got an asset that has kind of a room for explosive growth, that make it worth looking at these strategies at all. That takes us to 2:45 Eastern. This has been in some ways a whirlwind, in some ways a rather staid affair, walking through these factors. I think appreciate you, Peter, walking through this. This stuff is difficult to wade through and really important. Taking a step back, I think it's important for everyone to realize that it's really tough to tell for a layperson, a non-lawyer, a non-accountant or specialist, to figure out whether this stuff makes sense for a particular person, whether it's you or your client. And so, everything else being equal, if you're not sure, if you've got some assets, if you're kind of nearing high net worth status, if you're in the mid 7 figures, or if you've got that startup equity, those meme coins, that or regular crypto, or that high growth public stock, it's always worth a reach out. Get in touch. Schedule a call. You can reach me and Peter directly by email. You can always schedule a call with our team at valor.com/schedule. We are at your service to have these conversations, even at the starting point of, should I even bother thinking about these strategies? And if yes, then of course we can work through the kinds of things that Peter was talking about today. But always do not hesitate to schedule a call or check out the tools that we have on the site, the calculators, the guided planning, which can give you a directional answer and often a really kind of reasonably precise quantitative answer to, is this for me? Is this something that you should be thinking about pursuing? And if so, then let's chat. And in the last 10 seconds, I guess, just a plug for our next session, which will be covering charitable giving, specifically thinking beyond donor advised funds, which are certainly the most common approach to future charitable giving for reasonably high net worth individuals. There's a bunch more you can do with trusts and other strategies, foundations. And so we'll be spending an hour talking, or half an hour talking about kind of what else you can do on that front. That'll be Peter and Mani next week. So again, thanks, Peter. Appreciate you doing this. Thanks everyone for joining. I saw one more comment pop up. It was just a thanks. Thanks, Omri. Thanks, Tom. Appreciate you and your questions. And thanks everyone else for joining. We'll talk to you next time.